You've done it. You have built a brilliant AI model. It's faster, smarter, more accurate than anything out there. That's the golden ticket, right? Well, what if I told you that for a ton of AI startups, that brilliant model is actually a key ingredient in their failure? Okay, let's get into this.
Because this is the cold, hard reality. A staggering 92% of new AI companies just don't make it past their third birthday. So the big question isn't just, is this a tough market? It's why. Why are so many technically amazing companies collapsing before they even get a real shot?
All right, so here's how we're going to break it down. We're going to trace the path to failure, starting with the paradox itself. Then we'll look at the 4 main reasons they fail, see how those problems create these awful, vicious cycles, and then pinpoint the most dangerous stage in a startup's life. And finally, we'll uncover why the whole system is kind of broken and what it really takes to survive.
Let's kick things off with the big picture, the 4 failure factors. Because you know that common idea that startups only fail because their tech isn't good enough? Well, that's a huge misconception. The real story is always more complex.
Now, what's really interesting is the breakdown you're seeing right here. Yeah, sure, technical issues are the biggest single slice of the pie at 40%, but look at the rest of it. That means 60% of failures are caused by financial, organizational, and even bigger systemic problems. Success isn't about solving one thing, it's about juggling all of them at once.
So when we say technical failures, what are we even talking about? It's rarely about the model's raw accuracy. It's about dealing with messy, real-world data. It's the lack of MLOps, which is basically all the essential, unsexy plumbing needed to run your model reliably out in the wild, not just on your laptop. And it's that crippling technical debt that piles up when you rush a prototype and your code becomes a tangled, unfixable mess.
Next up, the money. And man, the financial pressure is intense. Building real AI is just incredibly expensive. We're talking about massive costs for cloud computing, for good data, and for talent. Just to put it in perspective, a single advanced GPU can cost thousands, and a small team of AI engineers can run you millions a year. All of this leads to funding gaps, a huge struggle to figure out how to actually get paid, and for some, crushing compliance costs in fields like healthcare.
Then, of course, there's the human element. Organizational failures are what happen when you have a team of genius researchers, but nobody who actually knows how to sell something or manage a project. Imagine a startup with world-changing tech, but without a sales team to actually get it in front of customers. It's just going to sit on a server rack somewhere. It's about founders who are technical wizards but have zero business experience, and it's about setting these wildly unrealistic timelines. And finally, there are the systemic factors. These are the big external forces that are pretty much out of your control. Think of new government regulations popping up, or a market that just isn't ready for your brilliant idea. Or you get stuck in what's called pilot purgatory. That's where you have a successful demo with a big company, they love it, and then nothing. It never ever turns into a real contract. It just dies on the vine. Now this is where things get really dangerous. These 4 factors, the technical, financial, organizational, and systemic, they don't exist in a vacuum. Nope. They interact and they feed on each other, creating these vicious cycles that can spiral a promising company right into the ground with shocking speed. We call this a feedback loop. And honestly, it's like a domino effect. One small problem triggers another, which in turn makes the first problem even worse. And before you know it, you are caught in a downward spiral you can't escape. For example, a tiny technical bug might make you miss a key deadline. That could spook an investor, which means less funding, which then makes it even harder to hire the people you need to fix the original bug. See how that works?
Let's walk through a classic example, the technical debt death spiral. Step 1. It starts innocently enough. You rush to build a demo for an investor. Step 2. But that messy, quick and dirty code creates technical debt. Step 3. Pretty soon your team is spending all its time fixing bugs instead of building new cool things. Step 4. This causes product delays, investors get nervous, and then the crisis hits. Step 5. You finally realize you need a senior engineer to clean up this whole mess, but now you can't raise the money to afford one. It is a textbook case of how one little shortcut early on can lead to total collapse.
And the same dynamic plays out everywhere. For instance, are you building cool features without ever checking if customers will actually pay for them? That's a validation deficit that just burns through your cash until it's all gone. Did your pilot program work technically but didn't prove any real business value? Well, that's pilot purgatory, a slow drain on your resources until someone finally has to pull the plug. These cycles are just silent killers. So we know these feedback loops are always a threat, but there is one specific period in a startup's life where they are the most lethal. It's a stage so notoriously difficult, people in the industry call it the Valley of Death.
So take a look at this timeline. In the first year, failure rates are high, but they're not totally off the charts. But notice what happens between months 12 and 24. This is usually right after a startup raises its first major round of funding, its Series A, and is suddenly expected to scale up, like yesterday. The failure rate just explodes. And that's because this is the stage where startups are under this immense pressure to grow, and they often make fatal mistakes trying to do it way too quickly.
And that's the number right there, 45%. Nearly half of all startup failures happen in the single one-year window. This is the moment when all that hidden technical debt, all the unproven business assumptions, and all that intense pressure to grow just collide. For example, a startup might have a fantastic product, but if they can't scale their operations fast enough to meet demand after taking that funding, they will fail. This is the Valley of Death.
So we know what happens, how it happens, and when it's most likely to happen. But to really understand this, we have to ask the biggest question of all. Why? Why does the system seem to produce a 92% failure rate? Well, the answer lies in this fundamental disconnect between how great AI is actually developed and how businesses are traditionally funded and built.
And this slide illustrates that disconnect perfectly. So many founders, especially the brilliant technical ones, are laser-focused on the stuff on the left, perfecting the model, building cool features, and just operating with this boundless technical optimism. But the market doesn't really care about your model's F1 score. It cares about the right side of the slide. Can you make more money from a customer than it costs you to get them? Do you have a real defensible advantage? In short, the market demands business realism.
This focus on tech over business leads directly to something called the commodity trap. See, the same amazing tools that make it easy for you to build an AI prototype also make it easy for everyone else. All of a sudden, the market is just flooded with dozens of products that look and feel the same. I mean, think about how many AI-powered writing assistants there are now. It becomes nearly impossible for any of them to stand out, and it just turns into a race to the bottom on price, where nobody really wins. And this quote, this just sums it all up. The 92% failure rate isn't some accident. It is the predictable result of a system where the slow, expensive, research-heavy reality of building sustainable AI clashes with a venture capital model that often demands explosive 10x growth in a single year. The timelines and the expectations just do not align.
So, is it hopeless? Not at all. But survival demands a radical shift in thinking. It's not about just building a more powerful algorithm. It's about adopting a completely different mindset from day one. It's about learning to think like a business person, not just a brilliant engineer.
This right here is the path forward. First, you have to escape that commodity trap by building something truly defensible. Maybe by focusing on a very specific niche market that everyone else is ignoring. You have to become obsessed with your unit economics, making absolutely sure that the money a customer brings in is more than what you spent to get them. You need the patience to build the right way, not just the fast way. And ultimately, you have to prioritize the health of your business model with the exact same intensity you give to your model's accuracy.
So, the whole point is making this transition. The single most important journey for an AI founder is moving from pure technical optimism to a grounded, clear-eyed business realism. This is the absolute key to navigating the Valley of Death and actually building a company that lasts.
And that leaves us with one final critical question. It's a question that anyone thinking about building something in this space needs to ask themselves right from the very beginning. Is what you're building just a brilliant model, or is it a truly viable business? Because the answer to that question will determine everything that follows.